Welcome back. U.S. stocks, as we've seen, are down today as the latest U.S. inflation numbers have investors convinced that the U.S. Fed may wait until mid-December before cutting interest rates a single time in 2025. Despite all that, our next guest prefers U.S. equities. Scott Wren joins us now from St. Louis, Missouri. He's global market strategist at the Wells Fargo Investment Institute. Scott, thanks a lot for joining us. What, first of all, is your take on this morning's inflation numbers and how they are being interpreted by equity market investors?
Well, good morning, Paul. And I mean, let's face it, across the board, I mean, these numbers were hotter than expected. When you look at the consensus for CPI this year, the consensus looking for 2.7%. We've been at 3.3% just because we felt like there were some underlying pressures in the economy, and we were trying to take into account the effect of whatever these tariffs might be, which is a little bit of guesswork right now. So, the market, I don't think the market's counting on a lot of cuts from the Fed. We've got one penciled in, and I think if we're wrong, there won't be any cuts rather than more. So I think the market's going to struggle here with how much is inflation going to go up? Is it going to go up? What's the Fed going to do? You certainly you're going to hear some talk, and you have a little bit lately about the potential for the Fed to raise rates. But I think when you take all of that into account, it could lead to a nice pullback, which we think is an opportunity.
How likely do you think a rate increase is from the Fed if we get more hotter than expected inflation numbers?
I think it's very limited. This little bit hotter number here, and where CPI and core is, I think that makes sense to us. But we don't expect inflation to climb from here. So I think it's a matter of the market adjusting to a little bit higher level of inflation than maybe was anticipated. So the Fed, Chair Powell and today and as well as yesterday, I mean, he's going to keep saying we're going to be cautious. We're in no hurry, because we know the last thing the Federal Reserve wants to do is cut interest rates a bunch, have inflation start to climb maybe higher than where we're seeing it, and then they have to raise rates. But I think the probability of a rate hike is very low, only because, at least in our work, we just don't think inflation is going to go much higher than where it is right now.
Okay, so you think a pullback in stock markets unlikely, and I think you referred to it as a nice pullback that would represent a buying opportunity. Why do you take that view?
No, we'd love to see, our forward look is good. I mean, I think that the labor market's good. Consumer spending is going to be fine. Earnings are certainly going to be fine this year. Hopefully, we'll see a little bit better global performance from these economies in the second half of the year. And so what we're talking to our clients about is opportunity, and whether that's trying to lock in interest rates at a little bit higher. Let's say the 10-year yield hits 5%. I think that's a great place to lock in some rates. And as far as equities, we want to be buyers on pullbacks. We really haven't had a good one since October of 2023 here. And really 10% pullbacks in the S&P happen pretty often historically. So I think after the huge run we've had since those October 2023 lows, to get a 10% pullback, or maybe a little bit more on just some fear that the Fed might actually hike rates, that's going to be a good opportunity. So I'd say anywhere, 10%, you get a little bit more than that, very doable. But that's when we want our clients to do what's hard for them to do, which is step into the market when they're a little bit nervous.
The large cap sectors that you favor in the U.S. markets are energy, financials, communication services, and industrials. What do those sectors have in common that make them attractive to you?
Well, I think most of them, there's some economic sensitivity there. Certainly industrials and financials, certainly in energy as well. And so we still think that if we see a little bit of a synchronized global recovery or better performance in the second half, there's really no oil supply growth. And so we think that oil prices are going to go higher. We've got an $85 to $95 barrel for WTI at the end of this year. Financials, yield curve, it's a little bit steeper, going to be a lot less regulation on financials. Communication services, that's just a growth sector that's likely to continue to perform. So I think that there's some economic sensitivity in there, and I think that it's the right way to play this. We don't want to be defensive. We want to anticipate better growth in the second half and still a good economy and an improving one internationally.
Scott, thank you, as always, for checking in with us. Scott Wren is Senior Global Markets